So the fund-to-fund model wasn't something that I came up with by any means, and it's relatively new to the scene, but from my standpoint, its use in my investment strategy was really born out of necessity. As more and more people began to ask me for access to the curated deals that I was investing in, I realized there needed to be a more inclusive investment model for my group. So many of the deals that I'm involved in have various hurdles, whether it be high investment minimums or simply access to the deal, or sometimes the average investor is just unfamiliar with the asset class. So it leaves a lot of investors out of the picture. So enter the fund-to-fund model. This model allows for more people to come alongside what I'm doing. Myself, I've been a full-time investor for well over a decade now. I've curated relationships and deal flow that a lot of people just simply don't have the access to. But with the fund-to-fund model, I can help solve the problem by aggregating capital and investing it in a more advantageous manner for the group. I believe this model will prove highly effective, especially for my investor group, because pooling our resources together, we can invest in a wider range of deals through one fund and potentially receive better returns than we could have on our own, for sure. So whether you are an experienced investor looking to expand your portfolio, someone just starting out, or anywhere in between, I believe you'll see the fund-to-fund model as a great way to invest, to get better negotiated terms, generally lower minimums, one-stop shop accounting, and really curated deals with most of the due diligence done up front for you. And you, the investor, control what deals your money go into as the fund grows. So here we go. I just want to kind of point out the differences between traditional and the fund-to-fund to start out with. I don't want to go into a ton of detail about fund mechanics and modeling, but just really want you to see the differences between a traditional fund and the fund-to-fund that we're talking about here. In normal funds, generally they're centered around one specific subclass of asset. We'll say multifamily. You give the sponsor of the fund money with the full confidence that they're going to go out and invest your money in a portfolio of apartment complexes, for example, that will give you a return over the lifetime of the fund. Now, once you invest your money in the fund manager then decides what assets the fund will be invested in. You don't really have a say in it after that point. There's generally, a 5 to sometimes up to 10-year lockup of your money in these funds, and the capital that you invest may or may not be called all at once. So all of your money may or may not be going to work for you immediately. The way the fund-to-fund model works is it gives the investor a lot more diversity than the traditional fund model. This model allows you to invest in several different asset subclasses, all within the same fund. The fund can offer many different investment options within itself. So you may see a car wash, a short-term vacation rental, mineral rights, apartments, debt, self-storage, maritime shipping. I mean, you get the point. But you, the investor, direct where you want your money to go. So, with my background and being an active investor throughout several different asset classes, it really makes sense for me to have a fund that offers my investors the opportunity to invest alongside in those deals as well. And it's really the diversity you get within the fund-to-fund model and you being able to direct where the investment goes that makes this truly unique. Another unique aspect of the fund-to-fund is access. The fund-to-fund model also allows the average investor to access to above average deals. The deals I offer in my fund, the public at large generally has little or limited access to. And these deals are often only for accredited investors. They're often for only family offices or institutional investors. But because the fund-to-fund model allows me to bring a large group of investors together that will invest collectively a larger sum, I get us a seat at the table. Or, maybe the minimum investment in some deals are $250,000 or higher, and that's just too big of a number for one individual investor. This model offers the flexibility in minimums. As the fund manager, myself, will set the number and that can be, considerably lower than what the deal sponsor is asking for. Or, there's several deals that are just offered to groups and masterminds and investment circles that I'm part of that fill very quickly. And I'll be able to offer that to my group through the fund model as well. And, it allows me, the manager, to be able to, use our collective to negotiate better benefits and terms for our group over what a normal retail investor would be offered in these deals. Maybe it's better overall returns, maybe it's getting access to a better class of shares, or putting us in a preferred debt position. Maybe it's lower minimums, like I mentioned earlier, or maybe it's a better preferred return. There's lots of possibilities, but coming in as a collective is always going to help us as a whole. Another differentiator is getting one K1 for all the deals that you're involved in through the fund. Let's say you're invested in a car wash, a short-term vacation rental, a development deal, a mobile home park. At the end of the year, we take all these respective K1s and coalesce them to give you one fund-specific K1. You don't have to worry about the hassle of chasing down all the sponsors for all the K1s. We have to worry about that, but you don't. You get one clean K1 at the end of the year, and you and your CPA especially are going to love you for it. This was mentioned earlier, but I really want to emphasize it because it's a major differentiator between traditional and fund of funds. You will direct where you want your money to go based on if you like the deal or not. To be clear, all of these deals that I bring to my group are deals that I'm investing in. So it's really just deciding whether or not you want to invest alongside me, and if it makes sense to your portfolio. And when you log into our portal for our fund, for example, you'll see all the deals being offered. You can click on the deals, read the OMs, see the webinar recordings, set up a time with me to talk to me about it, to learn more about it, or click to even put your soft reserve down at that point. But you don't have to invest a penny into our fund to sign up to see these offerings and decide if it's something that fits your investment goals. You only invest when you find a deal you like. So you are truly in charge of where your money goes to work. The fund also allows me as the manager to be very flexible how I want to enter deals based on what's going to give us the best return as a whole. If the returns are better as an LP or a limited partner in a Class A share, let's say, then that's how we'll enter. If it makes sense for me to be a co-GP as a fund, then I'll do that. It just simply offers a much more flexible product than the traditional fund structure does. One of the last differentiators is the lockup time for your money. With a traditional fund, your money is locked for the life of the fund. With the fund-to-fund model, the lockup of your money is really deal specific. If you want to have more liquidity, then maybe you invest in a debt deal that I have to offer, and you get your capital back in a relatively short amount of time. Maybe you invest in a mobile home park deal where you get your principal back in under 3 years. Or maybe you have a longer threshold and you're looking for more appreciation than cash flow. So you invest in one of our development deals. It's truly just very flexible. The point being, the lockup period is based on the deal you're investing in, not the fund itself. So I know this was a ton of information, and I truly do hope it was helpful and it gave you some insight and some key differences between the two funds that we discussed today. So what part about the fund-to-fund model excites you the most? Is it the diversification? Is it the flexibility? Is it the control you can exert over your own money? Is it potentially better returns? Make sure to let me know in the comments below. And here's to winning back your time.